Good morning, good afternoon, good evening. Some of the things I just want to discuss from the notes. In your notes, page number 2 is just showing the format. So no need to worried about this format because slowly and gradually you are going to learn the whole format. Okay. Now come to the page number 3. From this page, you just need to know which incomes are exempt incomes. You need to know them and you have to memorize them as well. Number 1 is income from individual saving account. If you are getting interest income, even dividend income from individual saving account, then it is exempt. Okay. The limit of individual saving account is £20,000 per tax year. So one individual can deposit maximum £20,000 per tax year in ISA. Whatever interest income is coming from individual saving account, that is exempt. And it is also not necessary that entire 20,000 must be in the form of cash. It is also possible that some of the amount you keep in individual saving account in the form of cash and some you can keep in the form of shares. If you have kept some of the amount in ISA in the form of shares, then if you get dividend income from those shares, obviously that is also exempt. But you should not be worried about this because even in ATX, examiner is going to categorically write that this is the interest income from ISA. You need to know one thing. Whatever interest income is coming from ISA, it is exempt. Okay. Now what else? Second one is National Saving Investment Savings Certificate. Interest coming from National Saving interest coming from National Saving Investment Certificate is exempt. Interest on repayment of tax is exempt. For example, let's say one individual has paid more tax to HMRC. So if someone has overpaid the tax to HMRC, so what HMRC does, number one, they refund the additional amount to that individual. In addition to refund, what HMRC does, it gives interest to that individual as well. And such interest income is exempt. Redundancy payment is exempt. Scholarship income is exempt. Gambling, lottery and premium bond winning is exempt. State benefit paid in the event of accident, sickness, disability or infirmity is exempt. So from this page, dear student, you just need to know what are the exempt incomes. Okay. The rest of the area, slowly and gradually as the course proceeds, you're going to learn by automatically. One more concept you need to know is qualifying interest. Number one concept, qualifying interest is not deducted from any individual source of finance, individual source of income. Actually, qualifying interest is not deducted from any individual source of income. It actually, qualifying interest is deducted from the total income of XYZ individual. You just need to know one thing. Qualifying interest is deducted from the total income of the individual. Second, what are the qualifying purposes? Because qualifying interest is only qualifying interest when the loan is being taken for a qualifying purposes. So let us discuss. If a loan is taken for any of the following, then the interest paid on such loan can be deducted from total income. Number one, investment in partnership. Let's say someone takes the loan and then invests in partnership. Obviously, on that loan, that individual has to pay interest. That is a qualifying interest. Investment in employee controlled company. Someone takes loan and invests in a company which is controlled by the employees. Third, to take loan, to give loan to a partnership where individual is a partner. Let's say you are a partner in XYZ partnership firm. You took the loan to give loan to the partnership firm. So whatever loan you have taken to give loan to the partnership, that is also a qualifying purpose and interest paid on such loan is a qualifying interest which you are supposed to deduct from your total income. To invest in shares of closed trading company. Closed company is a company where we have where the control lies between less than equal to 5 shareholders. If someone takes loan to invest in the shares of closed company, it is also a qualifying purpose. And the last one is the payment of inheritance tax on deceased personal estate. Relief is available for 1 year only. Let's say let's say that representative of that deceased person or relatives of that deceased person, what they did, they took loan to pay inheritance tax on the death estate of deceased person. So that is also a qualifying purpose, and interest paid on such loan is also a qualifying interest, and interest will be deducted from the total income. So for example, let's say Mr. Y is dead and his son is Mr. X. What Mr. X does, he took the loan just to pay inheritance tax liability on his father's death estate. So we will say he has taken the loan for a qualifying purpose, and interest paid will be deducted from his total income. One more which is missing over here, you should write it. That is, if an employee takes the loan to buy the asset and use that asset in employment, it is also a qualifying purpose. Now, let me repeat. If employee takes the loan to buy the asset and that asset is being used in the employment, so such a loan is also a qualifying loan, and interest paid on such loan is a qualifying interest, and that will be deducted from total income of that individual, not even from the employment income of that individual. Repeat. Let's say Mr. Z is an employee of XYZ Limited. Mr. Z takes the loan to buy a computer and he is using that computer, and he bought the laptop and he is using that laptop in an employment. So interest paid on such loan is a qualifying interest. And Mr. Z is not supposed to deduct interest payment from his employment income. He is going to deduct interest payment from the total, from his total income. So let me repeat, if an employee takes the loan to buy an asset which he uses for employment purposes, such a loan is also a qualifying loan. Personal allowance, all these things we know very well. We know these nil rate band, everything, I strongly believe. Now let us discuss this one concept, that is reduction in person. We know that how to calculate income tax liability. We know one more thing relating to basically when we are going to calculate tax, first we need to tax non-saving income, then saving, and finally we go for dividend. Every individual in UK gets personal allowance of 12,570, and the logic behind this 12,570 is so that HMRC should be taking tax only from those individuals they are generating income more than 12,570. But having said this, there is one more rule. What is that? HMRC says that wealthy individuals should not get the benefit of this personal allowance as well. So if there are wealthy individuals and they are having adjusted net income more than 1 lakh, then personal allowance limit of 12,570 starts reducing for them. So now there are two questions. Number one, how do we calculate adjusted net income? And if it is even more than 100,000, what difference it makes? How do we actually reduce personal allowance? So let me explain this. Basic personal allowance is gradually reduces for individual with adjusted net income is more than 1 lakh. How do we calculate adjusted net income? You have to take net income of the individual, deduct gross gift, aid, donations, and deduct gross PPC, gross personal pension contribution. This gross gifted donation is taxable in F6. It is examinable in F6, but it is not. Gross gifted donation is not examinable in ATX. Gross gifted concept is examinable in F6, but it is not examinable in ATX. Gross personal pension is obviously examinable in ATX as well as F6. Let me little bit explain what is this gross PPC. Basically, in UK, normally people, they are worried about their retirement age. So what do? They try to create funds so that at the time of retirement, they should not be having problem. And there are a number of ways to develop funds for the retirement age, and one of them is contributing personal pension contribution. What are the benefits of gross PPC? Let me explain. Number one, whatever individual is contributing in PPC, personal pension contribution, that contribution will be treated as 80%. 20% is paid by HMRC. Repeat. If individual contributes in personal pension contribution, so whatever he contributes, it will be treated as 80%, 20% is paid by HMRC. Second, with gross personal pension contribution, basic rate band, which is 37,700, it will increase. So in basic rate band, which is 37,700, we just need to add gross PPC, and high rate band limit will also increase, 150 plus gross PPC. So obviously, when basic rate band limit increases, so it is another benefit of this gross PPC. More taxable income then is going to fall in basic rate band. So obviously, you are going to save tax. Third benefit of gross PPC is it reduces your adjusted net income. Gross PPC reduces adjusted net income. So what is the benefit of reducing adjusted net income? What is adjusted net income? Now let me explain. Net income, whatever it is, from this we need to deduct gross PPC. So you will get adjusted net income. If this adjusted net income, ANI, if this ANI is more than 100,000, then personal allowance reduces. How? For example, let's say someone is having adjusted net income of 1,20,000, and the question is how much personal allowance that individual will get. Assuming adjusted net income is 1,20,000, and a very simple question which I'm asking is how much personal allowance this individual will get. All you need is just write the personal allowance, 12570 less reduction. You have to take adjusted net income minus 1 lakh, which is fixed, into 50%. So I'm going to get 10,000. 2570. So this individual will not be getting personal allowance 12570. Logically, this individual is going to get personal allowance of 2570. One more example. Let's say Mr. X is having employment income 1,25,000 and gross PPC is 15,000. Requirement is calculate income tax liability of Mr. X. We need to calculate income tax liability. Okay. So obviously employment income is a non-saving income. Which is 1,25,000. From this 125, we need to check how much personal allowance we need to deduct. After deducting personal allowance, we will get taxable income. After deducting personal allowance, we will get taxable income. Okay. Let me show working one. Net income is 1,25,000. From this 125, let us deduct gross PPC, which is 15,000. So adjusted net income is 1,10,000. Adjusted net income is 1,10,000, which is more than 1 lakh. If adjusted net income is more than 1 lakh, then personal allowance reduces. Personal allowance is 12570. Let us deduct the reduction. 1,10,000 minus 100,000 into 50% is 5,000. So we are getting 7,570. So this individual is going to get personal allowance 7,570. That's great. So we'll be deducting 7,570 from here. 1,25,000 minus 7,570. So taxable income is 117,430. So taxable income is 117,430. Now I really want you to calculate income tax. How you are going to calculate income tax? The basic rate band, which has a normal limit of 37,700, that basic rate band limit will actually increase by gross PPC 15,000. So let me show you how to calculate income tax. We need to calculate income tax. Now basically the basic rate band limit will not be 37,700. We have to add the gross PPC, which is 15,000. So 37,700 plus 15, it gives me 52,700. So 52,700 into 20%. 52,700 into 20%, that is 10,540. From this taxable income 117,430, from this taxable income 117,430, we just need to deduct 52,700. So in higher rate, we need to tax 64,730 into 40%. So 64,730 falls in higher rate. So it is 25,829. So here comes the income tax liability. So income tax liability, it is 36,432. One more thing I want to tell you, what is this? That is very interesting. Now the question is, why would people contribute in gross PPC? There's a reason behind this. What is that reason? Let me tell you. Very interesting fact. For example, let's say Mr. X is having net income of 1 lakh. Okay. He is not contributing in PPC. He has net income of 1 lakh. Personal allowance is 12570. Here comes the taxable income. Let us check what is the amount of the taxable income. From this 100,000, I need to deduct 12570. I'm getting taxable income of 87,430. Let's calculate the income tax. 37,700 into 20%. Let's say all the net income is coming from the non-saving income. 37,700 into 20%. It is 7,540. From 87,430, let us deduct 37,700. 87,430 minus 37,700. So I'm getting 49,730 into 40%. Into 40%. It is 19,892. So income tax, let us calculate. what is the tax payable? Tax payable 19,892 plus 7540. 19,892 plus 7540. It comes to 27,432. Now listen. Assuming the same individual, Mr. X, is having net income of 1,25,140, then what happens? Assuming Mr. X is having net income of 1,25,140. Number one, the personal allowance is going to be 0. Entire income becomes taxable income. Now the question is, why personal allowance is 0? Let me tell you first why personal allowance is 0. Look at this. Basically, he's not contributing in PPC, so his net income is adjusted net income. Repeat. This individual is not contributing in PPC, so his net income is adjusted net income. So personal allowance is 125,740. 125,140 minus 1 lakh into 50%. It is exactly 12,570. So he's not going to get any personal allowance. He's not getting any personal allowance. Okay. Now let's calculate income tax. Let's calculate income tax. Basic rate band is 37,700. We have to take 20% of this. 37,700 into 20%. 7,540. Now let us deduct 37,700 from 1,25,140. 125,140 minus 37,700. So I'm getting 87,440 into 40%. It is 34,976. Let's check what is the income tax liability. 7,540. It is 42,516. Look at this. Let us calculate what is the difference between these two liabilities amount. What is the difference? 27,432. The difference is 15,084. Difference between these two tax payable is 15,084. Repeat. Difference between 27,432 and 42,516 is 15,084. Look at the difference between incomes. From 1 lakh till 125,140. So logically the difference in the income is 25,140. Look at this. Mr. X, who is not contributing in PPC, just on additional 25,140, if I compare 1,25,140 with previous income 1 lakh, so there is an additional income of 25,140. And look at this. Additional tax is 15,084, which means that on this additional income of 25,140, Mr. X is actually paying additional tax 15,084. So if I tell you what is the effective tax rate, effective tax rate on additional income. So actually Mr. X is paying 15,084 additional tax on additional earnings of 25,140. This gives me effective tax rate 60%. Wow. So this means if an individual income grows from 1 lakh to 125,140 and that individual does not contribute in personal pension contribution, so logically he will end up by paying effectively 60% tax on his additional income. So simply, whoever is having net income more than 1 lakh, we should give advice to that individual that that individual should contribute in PPC. And if the after contributing in PPC, someone is having adjusted net income 100,000 or less than that, in that case, personal allowance will not reduce. Otherwise, definitely personal allowance will reduce. So I strongly believe now you people have really good idea about adjusted net income, when it reduces, and some of the idea of the starting pages of our my book. And what I'm going to do, I'm just going to start marriage allowance and other concept. Maybe I'm going to add that video into this, so I'll do this. Don't worry. So I will be starting with from marriage allowance concept. Don't worry.